definitely needs theme music. Okay. You can come out, Jeff. It's okay, man. Um, I'm gonna be back on later today. Okay. Is that okay, by the way? Is everybody good with the some of the coaching sessions that I'm doing in here? A little different, a little crazy, a little different. Okay. I want to show you crap like, you know, there's areas of options. It's fun to do the coaching sessions for me because I haven't even thought about this stuff in like 20 years. It's kind of fun because like I literally haven't thought about this. And by the way, when you're sitting at home and you're like, doing like the mental gymnastics around options, I'm going to tell you the exact same thing that was told to me very early on. I work for a guy, I would come into work when I was literally 22 years old. I'd come into work, I'd be like, I got this idea and you do this. And he's like, whoa, 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 whoa. He goes, how old are you? 22. He goes, by the time I was, a year or two older than you, he goes, I was doing the exact same thing. And he goes, you know what they told me? The same thing I'm going to tell you. Everything's been done, kid. Shut the hell up and just do what we tell you. It absolutely cracked me up. He's like, there's a call, there's a put, you can buy it, you can sell it. What else do you need to know? It's interesting because people are like, oh, I got this great trade idea. Like it has been done before. Everything's very efficient. So now you just got to trade around on the peripheral, on the edges, know your probability of touching. Jeff, how you doing, man?
Really, actually, this is a good day for me in the sense that I'm the only guy who's shorting certain stocks, and I've got 11 short positions on, and 9 of them are just absolutely collapsing today, which means that the timing is exquisite, which is telling me we're getting closer to a top. If my shorts are working, we're getting closer to a top.
Really?
Yep.
But but
You go
but
off the silver, I go off the broader market is what I'm doing. I look for the rotations is what I do.
rotate this, man. I've been waiting. I'm waiting. Okay. I'm not going off silver. I honestly, okay. I'm very leery when a market is this wild, this active, and at this magnitude.
Oh yeah.
And I just feel like no one's really taken into account the damage that a market like this can inflict. It doesn't necessarily have to crash. On the contrary,
No.
what happens if the crash is to the upside? Like if people are not looking at this. Like if SLV took off to like 130, like if you had silver, okay, in an instant, it could flash to the upside, gets to 130, 140. What are the implications to the broader economy? It's over, man.
Right.
Yeah. We want one of those like as it is right now, you can't even get RAM memory. Okay. Can't get RAM memory. Wait till the silver gets to like, 130, 140. Tell me about, all your chips out there. That, of course, every one of them has silver in there. I'm going to be like opening up old computers and, mining for silver. It brings a new thought to the idea of mining, mining for crypto. No, I'm pulling apart your NVIDIA chips and pulling the silver out. It's good stuff. I'm mining inside of I have so many like extra computers here too. How many extra computers do you have over all the years of having computers? Okay. And I'm
Me?
like,
Oh God, they're just sitting around. My wife's got 2. I've got 3 right in front of me.
yeah, it's crazy, man. I have
It's
stacked up
nuts.
laptops and so forth.
Oh
I don't know
yeah.
what happened to a few of them. I'm pretty sure my wife throws things away that I don't know about and forget about. So, by the
Out of
way, I'm gonna tell
spite.
you,
Out of
I
spite.
got, I got to tell you a really fun story, and then I got to let you go. So, we were moving originally to the island. We had a really big house here in Phoenix, and we had to clean it out. So we cleaned the entire house out. And we had this gigantic dumpster, and I'm just throwing all kinds of stuff away. And my wife, didn't know what something was and she threw it away. Okay. It was like my childhood dog's ashes and she threw them away. So whenever she's getting into it with me, I'm like, you remember that time that you threw away my dog? You remember Igor? Remember Igor that you threw away? It's quite the fun subject over here. I'm over it, but listen, I have no leverage whatsoever. So I take my shot where I can get it. Yeah, she threw Igor away, man. The ashes of Igor are forever gone. They are in a gigantic dumpster, and yeah, that's I got that going. Okay, nobody threw away my drums. You don't throw away that crap. Okay, I love the name Igor. Igor. It was a Rottweiler. It was a Rottweiler. Igor was like the perfect name. Had a little bit of a weird walk. It totally worked. All right. Igor's a great name. There's no Scooby. Okay. Jeff, I gotta let you go. I gotta turn it over to you. I'm completely out of control today. I'm gonna be back on for almost 2 hours with Garrett later today. So that announcement's coming. obviously 2 p.m. Eastern time. I'll be back on a couple minutes before that. So please tune in. It should be interesting. Yeah, I'm just going to make it. He's probably not listening right now, but we're going to beat the hell out of 2 hours. How's that sound? It's instead of Jeff, it's going to be beat the hell out of Garrett. Jeff, don't tell him. Make it a surprise. Jeff, it is all yours, sir.
All right. All right. So let me say good morning and welcome to the second hour of TheoTrade. I am Professor Jeffrey Bierman. I am broadcasting you live from Chicago. And today is Wednesday. It is January 28th. It's 2026. And as a reminder, it's the first day of the Genesis COG Mastermind Retirement Program. Begins at 1 p.m. today. For you members who are out there who are enrolled, you will get a Zoom link that is different to the WisePub that you get. So be aware of that. Be aware of the different link. If you're not in the class, I don't know why, you should be in the class. And I'm going to show you what the Genesis COG does that a lot of you just can't handle, because all my money's been made on the short side. Like, I'm just cleaning up on, how's he making money on the short side? It's because you're caught up in that stupid S&P product, and I'm going in a different direction. So we will get there in the second half today. We'll do a Genesis COG AI, which is artificial intelligence trade spotting, because I very much believe the algos rig, run, manipulate markets. And once you're on the wrong side, it's all over, because you're not getting out unless you just like clean out and give up, because the algos, they run the show. In the meantime, I recognize all of you out there, but I have so much to say in so little time. And the irony about that line is that today's theme is just right in sync with what I'm going to go to, because today's theme is pulled directly from Willy Wonka and the Chocolate Factory. How many of you out there have seen Willy Wonka and the Chocolate Factory 50 times? I've seen it 100 times. It's my absolute favorite movie as a child. It's my favorite movie as an adult. Not the crap that Johnny Depp made. That's garbage. And the one that Timothée Chalamet made, that's even worse. That's crap. You got to watch the Gene Wilder one. Everybody out there with Gene Wilder? Come on, give me it out there, Bart. Everybody. You got to love that Gene Wilder. It's the best one ever. Was made in 1971. So let me bring the picture to you so you can have a little bit of appreciation for this. Here's like the poster board of Willie. There's Gene Wilder, passed away years ago from cancer, was married to Gilda Radner. There's Jack Albertson, Chico and the Man, Peter Ostrom, who's still alive. And just to give you a little background on it, okay, about the Willy Wonka, just to give you, it was made in 1971. It was the American musical fantasy film, they called it, directed by Mel Stewart, from a screenplay by Roald Dahl. Love Roald Dahl. Based on his 1964 novel, Charlie and the Chocolate Factory, but they switched it to Willy Wonka and the Chocolate Factory. It stars Gene Wilder, Jack Albertson as Grandpa Joe. It's got Peter Ostrom as Charlie Bucket. Roy Kinnear was Henry Salt. Roy Kinnear was fabulous. If you ever heard Veruca Salt, okay, and there's a group that they stole from this movie called Veruca Salt. Julie Dawn Cole played Veruca Salt, and there's Veruca right there. Leonard Stone as Sam Beauregard, who is his father. I mean, this is just an amazing, amazing. Gustavus Galoob, absolutely the best movie ever made for its time. Nothing even touches it. But I'm going somewhere with this, so bear with me. Today's theme comes courtesy of Willy Wonka and the Chocolate Factory and the fizzy lifting drink. How many of you out there remember the scene between when there's only two kids left, spoiler alert, with Charlie and you've got the boy Mike TV, and fizzy lifting drinks, where Charlie basically breaks the rule with his grandfather and they drink the fizzy lifting drink? Come on, a set of hands out there, people. Let's see it. Let's go with the fizzy lifting drink, because I'm going somewhere with this. For you permables, listen up. The fizzy lifting drink. There's Charlie. There's Grandpa Joe. So here's the thing about the fizzy lifting drink, okay? It comes out in the movie, and there's a movie part and there's a book part. So let me talk about the movie part first. So the fizzy lifting drink comes from Willy Wonka Chocolate Factory. It's a fictional beverage, but they actually turned it into a marketable beverage that fills the drinker with bubbles, right? Allowing them to float like a balloon. So when you consume the fizzy lifting drink, the bubbles actually lift you off the ground until you hit a ceiling. And there's a ceiling up there where it's like a fan that could just like chop you up. The only way, and it could lead to massive trouble, the only way Grandpa Joe and Charlie can avoid getting chopped up in the ceiling fan as it's going up in like this like silo cone is that they have to actually burp. So actually, when they see it, they start burping, and the burping of the bubbles brings them back down to ground. And that part of the drink is a part of the whimsical, imaginative elements created by Roald Dahl in the story. So today's market comes courtesy of the fizzy lifting drink. And a lot of you may not know of this, but in the actual book by Roald Dahl, and this is truth be told, the fizzy lifting drink was actually tested on an Oompa Loompa by Charlie himself. Charlie gave the Oompa Loompa the drink, who drank it, who could not burp, and ended up lost in the sky. So the Oompa Loompa, there was no fan, actually went through a hole in the sky and blew away, like floating like a balloon, and just disappeared, and they lost the Oompa Loompa because the Oompa Loompa didn't know that the elixir was to burp or belch to release the gas and bring it back down. That's this market. This market is the epitome of a fizzy lifting drink. If you actually look at this market every single day, it literally goes up on air. It's literally like carbonated bubbles with no substance walking you up every day. And the thing is, everybody's taking credit. They're pointing fingers at the Fed, and they're pointing fingers at this person, and they're pointing fingers at Elon Musk, and they're pointing fingers at Trump, and none of that matters. Nobody cares. Even today's Fed announcement is a waste of time. The market doesn't even care. Nobody cares. It's all based upon algorithmic channels. That's the whole market. So if you want to see what the channel looks like today, I'll show you. You can't short it. I'm the one who said yesterday, any of you shorting are not going to make any money. Was I right? I told you, you're not going to make any money today either. Not. You have to roll this sucker down. But the problem is, okay, while we go up on just thin air and carbonated bubbles of garbage, and we're coming near some type of a top here. I'll go to the 30-day 4-hour. I believe we need to get up to that 70 or closer. Like last time we peaked at a 61 handle here. We peaked at a 763 handle here. And over here, we're at a 59 handle. So, as it were, we're on the way up, and the Genesis COG rules dictate that you can't short on the way up. It doesn't work. Go ahead and try. Just prove me wrong. Go ahead and short here, scalp and get 4 points. But as a position trade, how's that working out for you for the last 5 days? You've lost money every day on a position trade. I suggest you wait until the MACD flattens out on that 4-hour and you break a little bit towards underneath the 50. Then you can load the boat, short the hell out of this thing, and stop getting rolled into these terrible short squeezes. Over and over and over again, people are getting squeezed over and over and over trying to short this. Now, clearly, we're at some type of perhaps triple top, but we won't know until we actually break under 66.50 because that's the key level. So you're just levitating on a fizzy lifting drink. And part of that fizzy lifting drink is you're drinking some type, a lot of you bulls are drinking a Kool-Aid out there. You think that this market's cheap. It's not. You think that this market's being driven by valuation. It's not. Or a good economy. It's not. It's not driven by the consumer. It's not even driven by the government. It's driven by institutional algos. And there comes a time in this business when you're on the wrong side of the trade and you just can't get out of it. And I will show you what it looks like in my short positions, because right now the professionals are crapping a chimp, and I'm on the right side of a number of short positions where they're walking them down every day. And I sit there and go, it's not me making the money. It's the algorithms walking it down until the money managers just crap the bed and just go, I can't take it. And they start selling, which you haven't seen yet. You haven't seen that yet. So be aware. You're levitating on a bunch of carbonated bubble crap. And at any time, if we reverse, do you have an exit plan? All I'm asking is, do you have an exit plan if we drop 1,000 points today? Because if you don't, I ain't shedding a tear for you. People, the more we go up, the more you should sell. Just start lighten the load. Get out of your long positions. And like Garrett said, lighten the load. You're dealing with the market that at any time could blow because it's not on terra firma. It's not on firm ground. Now, individual type of macro stuff, okay? I call it cold hard cash. A report came out. I'm the messenger. I'm just the messenger. The report that came out from the government, okay, and the Bureau of Labor Statistics came out. 1 in 5 Americans, 20% of people in America can't afford to pay his heating bill this winter at all. Heating bills are up 15 to 20% across every state because of the Arctic freeze. In Chicago, it's 8 degrees outside. It's freezing. My heating bill's up, whatever. Can't live without it. I'm just pointing to you. If the economy's so strong as the Fed and the government and the president says, why is it that 1 in 5 Americans can't afford a heating bill? Why is it that people can't get a job? Because there's no jobs out there, but there's no layoffs either. Okay, so we're at a crescendo. We're in a peak, people. Hard to find a job. Electricity bills going up. Gas bills going up. Health insurance going up. I keep telling you this. The market is not run by people. It's run by machines, because people would look at this and go, hey, I got to lighten up. It's not. The machines don't react to news like this. They don't. But you do, and you can, and you should. So when things blow and you find out, I should have sold United Healthcare, it's down 80. It's too late. You had your shot. You didn't take the shot. Whenever a stock's up, I'm out. I don't even care. I don't care where it is or what it is. I want out of it, because nothing ever lasts in this business. Nothing. Even when I'm going to show you with storage technology, when they correct that thing, it'll become the next Zoom. Remember Zoom at 515? Yeah, it went down to $40. Okay? You're going to see a correction of just a magnitude. It's going to blow the market out at some point. So why wait until the last moment, like Don says? Second macro catalyst. Not again. Okay, the government is barreling towards a partial shutdown early this Saturday. It's going to happen. Now, the last few shutdowns, the market's like, what? There's a shutdown? Again, people care about the shutdown. The politicians care about the shutdown. But algos don't. Algos buy into overbought. They buy on pattern recognition and order flow. And everything else doesn't matter. I'm telling you, this is the type of business. And I've been around. I'm the oldest at TheoTrade. The gray hair, okay, the balding. I've been through all the stress. There is a day of reckoning. This is the most humbling business. It takes you from a level that you think you're awesome to you feel like you are just like flatter than like you're like a penny crushed on a train track. It's the most humbling business. I'm telling you, there's going to be a time when there's going to be a government shutdown and people are going to like, the last 10 shutdowns, the market doesn't matter. And at some point, it just trickles into the economy where people are like, I'm not getting my social check. Okay. I'm on furlough. I'm not spending as much. And it just trickles over into the broader economy. It's like, oh no, I keep ignoring the fact that there's signs there. I'm not saying this is going to drag the market down at all. I'm just saying my expectation is that people are going to see this news on Wall Street and they're going to go, who cares? They tried to shut it down in September, October, and the market made a new high. What does that matter? People, timing is everything. So you have the warning in front of you that there is likely going to be a government shutdown, partisan politics, and we're going to probably go into this air bubble of no news. And markets don't like uncertainty. This could be that air bubble that upends the market. I don't know. We will see. But you've had your warning from me. The third one is, I call it deal or no deal. You know where this, you know exactly where this is coming from. Like none of you should sit there and go, I don't understand what he's talking about. Oh, you know exactly what I'm talking about. Okay. Home buyers, and there's a show called Deal or No Deal. Home buyers are backing out of deals at the fastest pace in nearly a decade. So people are like, what does that mean? Okay, I'll give you an example of what this means. In the fourth quarter, particularly in December, 400,000 families, people, individuals, entities signed a contract to buy a house. Some were newly built houses, some were restored houses, some are non-restored, people are flipping, whatever. 400,000 Americans signed deals to buy a house. In the past 25 days, 50% of them backed out of the deal. Backed out, just walked away and said, not doing the deal. Either they checked the house and didn't want to do it, they looked at their finances and couldn't do it, looked at the stock market, whatever reason, they just said, we can't do this. What does this mean for the broader economy? Okay, this is the ultimate wealth product, not a car, okay, not like a diamond ring. This is it. $300,000-$400,000 investment, and people like cannot do it. It speaks to a number of things. It speaks to the consumer. American consumer is struggling. It speaks to the fact that housing prices are not low enough. It speaks to the fact that interest rates, while they have come down, the down payment on the house, not just the mortgage, but the front forward payment, people just can't make that work because they're looking at their monthly expenses going, sure like to buy a house, but this cost is up and this expense up. They're going through their budget line item and going, I can't make this work. I can't make this work. When does this start to matter? Apparently it doesn't matter because people on Wall Street are so wealthy that they're so detached in their hedge funds and their asset management funds that they're like, don't worry, this is the... At what point does this start to impact the consumer where people like, it doesn't matter what's happening out in tech land or bank land, okay? The economy itself is, I want to sell my 401k, I want to take my money out of that, and I want to live off of all the money I've made from crypto, all the money I made from silver, all the money I made from the stock market. At what point do people, the generation who are trying to buy houses, just start cashing out of the stock market and go, screw it, made a ton of money in the stock market, I'm going to take that money out to make the purchase of the home? At what point? Well, that's going to kill the market because that'll be a liquidation drain that Garrett's talking about. People, all of these are reasons not for the market to crash. These are reasons to let you know a correction is going to come, and you had plenty of warning. The last thing I want to throw out, just a factoid that I picked up on yesterday. It's the last factoid, okay? In the last 93 years of the market, it's a fact. In the last 93 years, the market has suffered at minimum, a 10% correction over a 2-year span. So if you go every 2 years from 93 years back to today, and we're now in the year anniversary coming up in April, every 2 years, and it doesn't say it has to be 2 years to that day. It could be 3 years, it could be 1 year, but on average, every 2 years, the market corrects at minimum of 10% every 2 years. And every 4 years, it corrects at minimum 25%. Think about that while you're out there, that statistic, because probabilities come into play, and eventually your number comes up and you're like, damn, could have got out of the market. Yeah, I don't want to hear it. Coulda, woulda, shoulda. I've given you 3 months to stop chasing this because the risk reward's so terrible, and to rotate. The only thing I see rotating into is I like the AI stocks now. I actually like them. They're value compelling. But most of the other things, there's a day of reckoning. Now, here is just individual stock stories, okay? The first one is I call more in store. And if you don't get that pun, I can't help you. Clearly, it's a gamma squeeze and a alpha seeking of a level that nobody's ever seen. Nobody can sit here and tell me and explain this away at all, okay? This is Storage Technology. It's a company that's an ADR. It competes with Western Digital, Seagate Technology. Look, Seagate Technology, not storage, but Seagate Technology, okay? There's no other way to describe this, period, okay? It's totally unshortable unless you're a gambler who's going to fight an algorithm. That's a Maribozu, a massive Maribozu. It's parabolic. It's gone from 274. Okay, it's doubled. Okay, is it a bubble? I don't know. I'm just telling you. Like, I call it more in store. Would I short this? No, because I'm not out of my mind. Would I buy it? No, because I missed the run. It's too late to buy. It's too early to short. I don't trade against algorithms. That's your 4 hour. That's your 4 hour. Here's your 20-year monthly, which is now sitting at an RSI of nearly 93, which I've never seen in the stock. I never saw that in Tesla. That's not even silver and gold don't even look like that. So you've gone from a stock that was literally at 30 bucks about 10 months ago to 400. It's up 1,300%. We all know why. Okay. This is what we call in the business, the tulip mania, meaning everybody wants to pay up for anything because it's financial porn and they think it's going to go higher. Is there more in store? I don't know. But this goes to show you, like, you can't short the market on the way up. And on the flip side, you can't buy the market on the way down, because there always comes a period in history when a chart like this turns upside down, none of you are ever getting out of this. You're going to stare at it and go, I'm going to buy on the dip at 400, then it'll go to 300. You'll buy on the dip at 300 and it'll melt itself to nothing. Be very wary of this. I'm not telling you to short or buy this. I'm just telling you, these are a sign of the times of what, momentum trading does. It cuts both ways, because there was a time when people like, screw it. I'm going to buy that Zoom at 588. And then it went down to $55. It's going to happen to Seagate eventually. Question is, are you going to get off that train in time? I don't know. It's up to you, not up to me. I'm not going to short it, but I'm not going to buy it. But it's a sign of the times why the market is being held to a standard up this high. The next on here is this, okay? High voltage. So Texas Instruments comes out yesterday, and what Texas Instruments does is a million different things. They're not just a one-trick pony. Don't you ever tell me that Texas Instruments is just they make a calculator. That's a bunch of crap. They do everything. They're all over the place. They're one of the most well-diversified companies on the planet. So if you're going to come out and sell me that crap, I'm going to bite back at you and say, okay, you know what you're talking about. This is a company that does everything from batteries to semiconductors it runs the gamut. Just go to the analyze page and look how thick, ridiculous this is, from what they do to processors to automation, electronics. They're all over the place. They're planted everywhere. Here's the story about this stock that's interesting. And I warned you, all of you, day after day after day. I don't trade around earnings because it's not about intelligence. It's about experience. Markets make up their own fake narrative, do whatever they want that goes against the grain and conventional wisdom. Here's a company that came out and they reported $1.27. They missed. And yet the stock had already rallied $50 ahead of that miss. And the earnings were not that sequentially that much better from where they were the previous year. So you have to roll that through your head. You're like, hey, there's $1.27. And then you go over here and you're like, let me look at this thing and say, well, where was it a year ago? A year ago, it was $1.30. So let me get this straight. Let me clarify this. Wall Street's fuzzy math. Here's a company that reported earnings less than last year, a sequential decline, and the stock's up $70. Make sense of that, people. Make sense of any of that, because it doesn't make any sense. All the company said was, we have a decent backlog ahead of us for the next quarter, and that ran it higher. What's the lesson you learn from here? The lesson you learn from here is, around earnings, never short and never buy. Just buy the straddle. That's it. Buy the straddle and pray. Don't pick a direction. If you're long, you buy the put. If you're short, you buy the call as a sacrificial lamb. Company missed, and they still ran it up $16. All because they said, well, we like the backlog. Tells you the market doesn't look backwards, it looks forwards. And yet it was a sequential decline, and it still went higher. Go figure. Next one here. Always something to learn. I call this, quote unquote, the caffeine high. Now, I say this, never, ever, ever, ever short before earnings, if you can help it. Don't stand in front of this, okay? Why is the market going up? There's your answer, okay? At one point today, Starbucks in pre-market. I kid you not, because you got to look at the pre-market to really get a handle on this. Here's your pre-market. Forget the extended. The regular. You got to look at pre-market to see this. Somebody came in. Some retail person came in. Okay. Basically has skid marks on his underwear. He had to take off his shirt and change and put on more deodorant. And basically covered a short or bought it 105.72. I can't handle this. Help! It just lost control. Let's just break this down. What did the company report? They missed. The company is a has-been. The company is not even worth $30. That I told you all. Nike was the biggest scam at 190. Was I right? It's the $60. This is a scam. It's a great company, but the growth isn't there and never will be there from now to the end of time. But all the company said was one thing, and that is, you have to read the headlines. One piece of news they ran with. Starbucks says, okay, that their coffee customers are coming back. They didn't completely specify at all. They said they see inflation and tariff headwinds peaking in the second quarter. So what they did was they gave the market like a timeline. They gave it visibility. They took away the uncertainty, said, by the end of the second quarter, which is the end of June, we're going to start to see customers coming back. Like as if Starbucks has the prophetic foresight to see that. That was enough to get people aboard the bandwagon and chase momentum. And what I keep telling you is you can never, ever fight an algorithm. It will absolutely destroy your account if you just fight an algorithm. That is a parabolic move in that. So if you're shorting this, you clearly don't get the business. You're trying to trade against an algorithm. Now, if you would hit that short at 105, you did well. But at this point, you might see it stabilize and try to work itself back higher. I keep telling you, you don't think that earnings matter or valuations. I'm telling you, they matter. That stock with that statement could have gone to 117 and basically broke a lot of your accounts shorting this if it weren't for the fact that the PE ratio is in bubble land. That's a bubble PE ratio. So if you're paying 60 times earnings for Starbucks, I would fire you. If you work for me, you'd be fired. You can't pay for a company that's no longer growing at all. There's no growth in this company, period. There's no sales growth. There's no earnings growth. It's just typewriter futures. It's AT&T. It's a fully saturated market. It's not going anywhere. It's like McDonald's. McDonald's goes up 5% per year. That stock shouldn't move more than 5% per year. You're trading around narrative and around volatility. And I'm telling you, at some point, you're going to get dunked in this thing. You're going to get whipped. Would I short this stock now? I would not. I don't short against trend or momentum. But I'm telling you, follow the institutional money flow because it's never wrong. And I'm telling you, if you follow the institutional money flow on this, and I'll bring it up for you, what it looks like, you're going to get a much more crystallized picture of what this actually looks like. Don't trust the candles. Don't trust what you see. Somebody's getting out of this. The hedge funds and the asset managers, they're selling this stock. It's higher. Don't care. They're selling it. This is what we call a bearish divergence. You're buying what they're selling. Now, I won't trade against an algo, but I can tell you, without institutional money wanting to own this, if you put it in the hands of an algorithm that doesn't get enough order flow, they could take this back to 90 bucks or 80 bucks. Be very careful. This is a gamma squeeze. They gave visibility or what they thought is. Don't trade off that crap. Trade off the value, trade off of a good entry and a good exit, and make sure if whatever you do, you always track the money flow. If you don't track the money flow, you're going to get burned eventually. It's one of the key things of the Genesis COG. We watch money coming in and out all the time because that's what ultimately what turns things around. Now, the last thing I want to throw out is this. So I can take this off, clear the drawing set. Okay, one last one I want to throw up here, and then we'll get to the Genesis COG. Okay, restaurant quality. So Brinker International is one of those stocks where in the Genesis COG, okay, we call it a sacred cow. These stocks are virtually impossible to short. Virtually impossible. If you short this stock, it's a widow maker. You will get blown out at some point. It's really hard to short this. This is a stock that reported really good earnings, but I want to point this out, and this is where the Genesis COG starts to come in. Notice how some people chased it at 168. I want you to see this. Somebody paid that up, and now they're down $11, and they're in therapy, and they're probably standing over a bridge with like a rock around their neck, ready to jump into a lake. Was this you? Raise your hand. Go ahead. Admit it. There's a lot of you out there that bought this today. Okay. What is the mistake you made? Number one, you acted way too fast and early. You didn't do the Corey Rosenblum. You didn't do the DePochi. You didn't do the Tony Rago. You have to wait 30 minutes. Wait 30 minutes. Don't let it settle in. If you bought there, you're dead. You're not getting out of this. Their earnings were spectacular. Okay, they were phenomenal. Two things. It's already priced in. And two is the secret sauce to all the algos comes down to a few things. But the institutional money, you're dead. If you bought this, you get out now. Buy a put, get out of this now, and then send me a love letter in 6 months. You're buying it at the top of a move where the MACD is rolling over. If that weekly MACD rolls over, that's what's going to happen, and you're going to be blown out. This is one of the most volatile stocks I have ever seen. It's got 44 million shares. The PE ratio is very reasonable. That's not expensive. That is not a bubble. Not. But I'm telling you, the stock had already priced in that move. The key to the market is you have to realize whether it's priced in or not. Apparently for storage technology, it's not. For this, it is. So if you own this, I think you're in a little bit of trouble. It might pop back to 160, 165 if I were you. I would get out of this, but I wouldn't necessarily short a stock at a 16 multiple. Be really, really careful how you trade this. They're like, they do Chili's and they do Maggiano's. They're a restaurant, quality restaurant company. Just want to show you what it looks like. Now, for the program of the day, I do this once or twice a month. So if you're not in the Genesis COG program today, okay, I understand, but I'm thinking maybe you should start like rethinking what you should be doing. Okay, start rethinking around this. So let me kind of bring this to your attention right now and show you, okay, COG spotting. Now, a lot of you are long. I'm not going to talk you out of it. Good for you. Did you make a lot of money? Great. Make sure you book it. Make sure you protect the capital. Make sure you put it away. That's what we do at Genesis COG. We make money, we out of the trade, and we walk away. We book gains on Cheesecake Factory. We book gains on SYY. Okay, we book gains on a lot of things. We just get at them on the long side, right? But I'm going to show you. If a lot of you don't have a hedge in your portfolio where you're like, I'm 100% long, okay, you're fully at the behest of the S&P. Because when the S&P tanks and you're fully long, okay, you're completely vulnerable. You have no hedges in place. You have no what I call discorrelation or asset correlation, like breaking it apart. Here are 3 short positions. How many of you have the actual cojones, the iron constitution, to walk into this market, which never goes down, never, and get short? I do. Want to see how we do it? Okay, I'm going to keep. We got a lot of short positions. Here are 3, and only one of them is not really doing well, and it's only down like barely, like by $1. So here it is. Okay, first one is Jefferies Financial. I'm short Jefferies. Are you? Are you long? Why am I short this stock? A few things. Okay, number 1, in the Genesis COG footprint, it's not all technicals. There's a lot to it. Look at the valuation metric. Look at it. Okay. Now go to its peers. Go across to its peers. It's a 5 handle higher. 5 handles higher. 4 handles higher. It's not a bubble, but it's mispriced. They should all be aligned by a PE ratio or 2 when it comes to a certain sector. The financials have been stretched as far as they're going to go. The only reason why the financials are stretched is because the Fed has been cutting rates consistently. If the Fed stops cutting rates, the financials are going to absolutely implode and crash. That's your only hope you got. That's it. Cutting rates helps financials. Raising rates destroys them. Remember I said that, okay? These banks and these brokers. So we went out, we read the chart, we screened it, and this is what we did. And that being me. And I've also got my own scanner that does this. But the scanner does not, I repeat, does not integrate fundamentals. I do. The scanner does not post alerts. I do. So you have the advantage of my fundamental knowledge and my careful curation around trades. This is the stuff that a lot of you just don't get, okay? This is an uptrend. That's obvious. I'm not going to argue with you. It's an uptrend. I'm not saying it's not. It's still an uptrend. But once an uptrend is broken, okay, by the momentum, and it turns into a sideways flag formation, this is where I get rich, and you sit there and you miss the opportunity. This is where the Genesis COG members get stupid rich. This is how we do it. What are the probabilities of this stock going up? Not very good. It's broken the momentum. What's the probabilities of the stock going down? Not very good either. Does it matter? No. If you ever listen to Kaufman, it doesn't matter. Here is what matters. What matters is that as long as it sits in a sideways move and doesn't go up or down, theta decay selling premium will come back and pay me. I make more money off of selling premium than probably most of you buying calls and buying puts. Selling premium, even in a defined risk, keeps my risk so stupid low that I wake up every day and go, it doesn't have to go up. It doesn't have to go down. If this doesn't go down, I just don't care. Just don't go above. Pardon me, I have the wrong one up. I'm going to go to Jefferies. Let's go to Jefferies. Even better. Look at Jefferies. So I'm going to go to Jefferies. Pardon me, I missed that was Goldman. Come on. What am I, new? Okay. It broke the momentum. So I waited for it to bounce. The dippers come in, which they always do. And I'm like, right there, I'm going for it. So I started getting short around that 63, 64, 63 and a half is my average price. Look at the trade. Look what I've done for the Genesis COG members. Look at us make money. Is it going down? Not really. Is it going up? Nope. Who cares? I'm in a 65 spread, $3 wide. I'm in a $5 wide. If it doesn't go up, I max out. I'll make 100%. Like I literally sold it. I'll make like 100% return. All it has to do on expiration is not be above that level. Why don't a lot of you do this? If you join the Genesis COG, this would be an opportunity for you. Low stress, low risk. You sit there every day and going, the market's going nowhere. Who cares? You're still making money. I'm in a short trade on this in a couple of call spreads. And I don't literally, I wake up every day. I don't even look at this trade. The only thing I care about is just doesn't break above the upside of this channel, and I'm good to go. I've got all the way up to 69 to worry about this. Look at the downside. If I'm right, it goes to 51. If I'm wrong, I stop out of it at 69. I like my chances, people. I really do. It's broken on all my indicators. No money's going into this. And yet I keep printing money every day. So while you're out there begging the market to go higher, I don't care if the market goes up or down. I'm just making money off of call spreads all the time. All the time. And sometimes I'm short the stock and sometimes I'm not. Let me give you another example here. Okay. I'm short Henry Schein. Who's the idiot who would short that? I'm that idiot. Okay. It's the Genesis COG. What we do is we identify algorithmic activity. We decode what the institutions are doing with all these kind of like funky boxes. So what I saw on this was pretty basic. All I did was I connected from where they reported up here. And I said, if this thing breaks anywhere underneath that 78, 79, and I happen to get in this at 79, 75, I was a day early. Okay. Baby needs new shoes. So I'm in two call spreads. One's an 80, 85, which is virtually worthless now. And I got about 2.25 for that one. And I got 3.55 for a $5 wide 75, 80. Now, these are going to expire in about 20 days. All I need is for that to sit there and go nowhere and just end at 75. And I bank on both of them $600. For doing what? Nothing. Not sitting here stressing, not praying, go, like you're rooting, like you're in a football game. Come on, Seattle. There's no rooting. I just sit here and go, listen, all I did was I decode what's happening and figure it out. I'm not fighting the relative strength, which is weakening. I'm not fighting the MACD, which is breaking down and creating greater disparity. So the greater the divergence, the more the algos just shove it over the hill. They're pushing it over. No money's going into it. Look, the money peaked. There's no money going in. And if you look at it on a day by day basis, look, okay, here's a lot of short covering right there, but it fell out there. My favorite's the 1 day 5 minute. Okay, there it goes. Some institutions are just getting out. That's it, people. Somebody wants out. Institutions want out. So the algos step in and buy it. Why? Because the trend is still up. The momentum's broken, but the trend is still bullish. Doesn't matter to me. All I got to make sure is that the momentum doesn't go back bullish, because if the momentum goes bullish with the trend bullish and they realign, I got to get out of that trade. It'll just go up and squeeze. The market is being run by these sugar high momentum pushes that nobody seems to be picking up on TV. Don picks up every day. We sit here and go, this is a joke. It's a joke. Algorithms push it higher and institutions go, fantastic, let it go. But once it breaks, the institutions get together and go, damn, there's a broken momentum. Let's take some risk off. And they start to sell to the algos that buy those dips and then hold it in place. If the institutions sell heavy, the algos will just cancel all bids and let it crash, just like they did with United Healthcare. United Healthcare crashed, no bids. Algos don't buy broken trend. You do. So you watch momentum, you watch trend. This is what the Genesis COG does. We do it efficiently and systematically. We don't make money on every trade. We manage for risk. We don't predict. We just watch day by day by day. And the beauty of this trade on Henry Schein, which is a pharmaceutical company, okay, and they do a lot of medical products. Okay, here's the beauty of this trade, okay? And you got to look really closely. why this thing is going to probably turn out to be a home run trade, look at it yourself. If that MACD closes underneath, the algos will absolutely destroy this thing. Everybody who owns this is going to crap a chip. They're going to go, God, gotta get out. They're going to panic just like this. I don't think I'm right. I know I'm right. Take a look right there. The algos repeat themselves all the time. You can't short on the way up. Doesn't work, but you can't buy on the way down. You can short on the way down all you want to. All you want to. You can short at 70, you'll make money. The difference is we identify that critical point where the risk is the lowest and the return is the highest. That's what we do. We don't manage for home runs. We manage to survive. We hit singles over and over and over again. Occasionally, we strike out, we lose. But if you pyramid the singles and the doubles, it just adds up after a while. The winners just kind of start piling up. There was a short there. We got that one. I waited and waited. I'm not going to buy on the way up. I'm not going to pay 24 times earnings for this stock. I'm not going to do it. I'm not interested. I don't care. I'm not paying 24 times earnings for this stock. It's not worth 24 times earnings. If you look across at its peers, okay, and you go there, you're like, what about Bristol Myers? 18. Merck, okay, that's starting to break down. 14. Why would I pay a 24 handle when I can pay a 14? It makes no sense, okay? So I just started going, I track this stock. It's not the greatest liquidity, but Henry Schein is on the way down. So while a lot of you are out there going, what can I buy next? Guess what I'm doing? What can I short next? I got plenty of long positions, whatever. I'm just sitting here. Some are working, some are not working. They're defensive. The market's just rolling through, okay? I'm cleaning up on the short side. As soon as that market breaks and we correct through 6,600, I assume all my longs are going to take off because they're all defensive plays at 52-week lows that have very little downside. But the money managers, they're so gung-ho on looking at charts that they can't see opportunity when it hits them in the face. They're going to look back and go, damn, I could have bought that. I bought Merck at 72, people, 77. Look at it at 109. Nobody wanted it then. Of course, nobody wants General Mills. When it goes to 70, they'll get 10 upgrades. Stop looking for momentum all the time. Momentum's great, but to diversify is looking for opportunity where somebody's trash is your treasure. Let me give you one more short trade. Well, everybody's out there, and I respect Corey Rosenblum immensely. Everybody's out there just rambling on about, I've got to buy Walmart in every dip. No. We took the Walmart short, and we're out of the stock, but we're in a call spread. We got a call spread working. We got a 121, 124 working. I got 2 weeks on this. As long as this is below 121, okay, I'm good to go on this. Not going to worry about this. So you see Walmart starting to work itself lower, okay? When I looked at this, I looked at it from this perspective. It broke the actual momentum channel. There's the key. You can't short on the way up. It never works. You have to wait until it goes sideways or rolls over, where it becomes what I call a two-sided market. A two-sided market. Two-sided, which means that there's buying and selling. Because on the way up, there's only buying. Look, there's no selling here. There's no shorting here. You can't make you'll never make a dime. Keep shorting that, you'll blow your account out. You can't make any money. Algos aren't selling, institutions aren't selling. You're the only seller in the crowd, so you're not going to make any money. Let it play out until the slope changes. Once it went flat, I started getting in here. I tiptoed lightly into it. I got a 121, 124, and I've got a 116, 119. I got one of each. I wanted to see if I could get more premium off of one versus the other. I'm in the money barely on one, but I'm still ahead. I'm out of the money by $5 on the other, $4, okay? Understand this. That is a gamma squeeze where they cleared out basically every short seller on the planet. Every short seller is gone in this stock for a lifetime. There it is. That's a gamma squeeze. They got everybody out. That's not accumulation. That's panic short covering on a gamma squeeze on here for people who got timed it wrong. If you flip the script and look at this on a weekly basis, you see something completely different. The differences in this is, number one is the MACD is not going up. The weekly MACD is flat. Now, that's not a sell signal necessarily, but if this curls underneath and we get that long correction, that stock is toast because it's a bubble. You can't have a stock trading at 41 times earnings that's barely growing at about 8 to 10%. That's a bubble. But what you learn about Wall Street is it matters until it doesn't matter. If there's anything I could teach any of you about fundamentals, it's this. Everybody will buy on the way up forever at any price. But the one time that a company reports and the professionals and I used to work and the people at Zacks know this better than anybody. I'm not promoting them. They know that when you stumble for one quarter and you break in gap, it's the end of you for about a decade. You're done. You're not getting in that stock, period. It's already happened to Costco. Nobody wants it anymore. What happens is the stock goes through a long-term, what's called multiple compression. You keep going up because you're pyramiding earnings. But once the market senses that your compounded annual growth rate can no longer sustain this type of angle, this type of trajectory of growth, it takes years, months, decades to unwind you and blow you. It happens to every stock. There's no stock that is above reproach. They get them all. I promise you. So you're like, well, what the hell happened to this stock that was doing so well? They compress the multiple. You understand? You can buy your storage technology all you want, laugh me in the face. The one time they gap this down, that they don't tolerate that multiple, it's the end of you. You're never going to get out of that thing. Some people I know are still in this. They can't get out. They're down 300 still praying. Prayer is not a strategy. When the multiple compression starts on the E-mini, a lot of you are going to shit the bed. You're going to go like, what am I going to do? You don't understand. That multiple is going to go from a 39 to a 23. They could take it down to 3,000. Will they? I doubt it. But they can do it. The multiple will drop and drop and drop and drop until they get into a 5 or a 4 handle. They can do that. Okay, they can and they will. At one point, Wells Fargo, right over here, was trading at a 6 handle. 6. Now look at it. Wells Fargo, it's at a 14. Did you panic and sell at the 6? Congratulations, genius. How much of a fool do we feel like now for doing that? Don't panic when the valuation's low. Don't panic when it's high. When it's high, get out. Because as soon as they stumble one quarter, they're going to walk you into hell. Roblox stumbled one quarter, and now nobody can get out of this anymore. I can't get out. You're not going to get out. It's not going to go back up because they don't have any positive. They have no positive quarters. They could walk this down to 25 and leave you just like Peloton. I own Peloton. Really? You own Peloton Interactive? Yep. Well, look at that multiple here, people. Here's your 10-year Peloton. They crush it's not that the company's going bankrupt. They're crushing the multiple. They crush the multiple on everything. Everything that multiple gets destroyed once they figure out the peak earning on it. So I'm warning you, like, what I do best is I go in, I find out where that peak multiple is. That's what you pay me for. Where is that peak multiple? Where is the entry? Where's the footprints where you can go in, take that trade and say, okay, I just want to hit a single or a double. I just want to swing trade that thing for a few points. I want my risk mitigated so I don't have a risk of ruin trade. And I grab and go hit and move on. That's what we do. We use the machines at our behest to figure out and read and decode what they're up to. If you don't, you're just basically like roadkill in this business after a long time. That's going to go down. It's going to correct 1,000. I guarantee it. I just don't know the day. But when it happens, don't say I didn't warn you so. They have to cycle this thing downward eventually because the valuations don't make any sense. Now, the last part of this program for just 5 minutes, I got an email from a TheoTrade member, and he was very polite and said, I need you to do me a solid. And I said, well, what type of solid do I need you to do? He said, I need you to help me out and tell me, give a little background on what a closed-end fund is. Okay. What is a closed-end fund? All right, let me bring up a little bit of a graphic to show you what a closed-end fund is, okay? Here's what a closed-end fund is by definition, so you understand this. A lot of you in your IRAs, your pensions, your 401ks, some of you own mutual funds. It's not the same thing, not. A mutual fund has endless amounts of money that can go in. It has endless shares that you can buy into that fund, not a closed-end fund. They call it a closed-end fund because there's a fixed number of shares. It's like a stock. A closed-end fund trades like a stock. It is a stock. Now, there's only a few hundred closed-end funds out there. there's about 250 to 300 closed-end funds. There's 5,000 open-end mutual funds. So in a closed-end fund, think of it like a stock, okay? Most closed-end funds will either sell at a discount or a premium. That is where arbitrage and the arbitrageurs come into play. They calculate the net asset value in the shares, and they try to figure out, is there a discount? They buy it, pocket the difference. If it's at a premium, they short it, they pocket the difference. So the discounts will fluctuate over time. A closed-end fund is a fund. It's a stock, but it's a fund. It's a fund because it's a basket. It's a basket of stocks is what it is. It's a basket of products, not one product. It's a product that contains individual products in that product, but it's not a SPAC at all. So a closed-end fund trades all the time. A mutual fund doesn't. A mutual fund trades once a day, and you can only get the mutual fund price after the markets close. So whether you sell a mutual fund or buy a mutual fund, everybody who buys or sells gets it after the markets close 1 hour later when they do the mark to mark, and they figure out the NAV, the net asset value. So despite great academic research, the phenomenon trying to explain closed-end funds is still elusive and dubious. A closed-end fund is a really good form of diversification, but you have to understand the differences between the two of them. Open-end funds, okay, you can buy for sale at all times, but you still can't get a fill until after the market's closed. The unit capital variable is not fixed, but it's variable. It will change. In other words, the number of shares will change. If you want to buy into a mutual fund, they'll issue new shares. They can do that. If it's all filled up, there's no sellers, you're like, I want to buy into that fund. They'll just issue new shares. It's like pulling stuff off a toilet paper roll and going, here's some more shares. It's open-ended. It's open because there's no fixed amount of shares. It's an open-ended amount of shares. That's why they call it open-ended, okay? The investment goes up, the more subscriptions, the more money comes in, the more they spend, and the mutual fund goes up. Closed-end fund doesn't work like that. A closed-end fund is a basket of different like individual stocks in that fund where that usually provides some form of massive dividend payout. So investors, okay, are not allowed to buy or redeem units directly from the fund. Okay, some funds offer repurchase fixed period, like UITMIP offers repurchase after 3 years. These funds are actually listed. They're listed on the stock exchange. There's hundreds of them. And they're not listed on the NASDAQ. They're technically listed on the New York Stock Exchange. And they'll either trade at a premium or discount. Now, you're probably not sophisticated enough to know whether or not it's a premium or discount because there's a funky formula. The algorithms are on it. There's ARB free. Okay, you're not going to be able to exploit these. So when you go into these open-ended on these closed-end funds, couple of things. I'll bring one up for you. DPI. Okay, or is it DIP? I think it was DIP. Was it? It was a. I thought it was one. I think it was DPI. I got that one wrong, or was it DIP? Come on now, was it DIP? No, it was DPI. I'm not sure why I can't find that symbol. Short income fund class B. Is it not there? I'm surprised it's not there. Hang on one second. I had it up earlier. I kind of overlooked it. So let me bring this one up. It's the PIMCO fund. The fund symbol is, I think it's PID. I think I had it backwards on here. So let me see the fund. Let me see if I got it right. Pardon me as I go through this. Accept it, check the box. I think I got it backwards, but it's an income fund. I will get the symbol for you. There's a few hundred of them. This was a PIMCO fund. The symbol is not coming up here. Are you kidding me? It's not coming up here. It's probably PID or PIM. It's one of the three. PIM was a PIMCO, Putnam Master International. That's one. Here's PID. I think it was the other one. Okay, there it is. Invesco International. Okay, so it's an income. These are income funds. Let me see if this one fits under there. I think it might have been PIM. It's not. I think it might have been PIM. Is it PIM? Okay, no, it's actually higher than that one. It may have been PID. Can't remember. I somehow at PMI, it slips my mind. But the idea behind the fund is, okay, they tend to pay massive dividends. Massive. Be aware that you don't buy the fund for the dividend. You buy the fund because you want the actual closed-end fund to go higher. Because even if they pay you a dividend of 10%, you have to hold it for the whole year. And if the stock drops 10%, it negates the 10% dividend. So you start out losing, it has to work its way back, and it's a wash and a waste of your time. The second thing about closed-end funds, the second thing about a closed-end fund is simply this, and I'll see if I can bring this one up. I'm just trying to find a symbol that works here. You could actually, believe it or not, you could actually step in, okay? NMAI, there it is. Here's another one. Here's a closed-end fund, okay? They tend to pay massive dividends, see? Here's the thing about closed-end funds. You can short them. You can't short a mutual fund. Cannot, against the law, against all restrictions and exchanges. Nobody can short a mutual fund. Can't do it. You could short a closed-end fund. But if you short that closed-end fund, you better know how to price it accordingly. You better. Because if you get squeezed, the point of no turning back sucks. Not to mention, if you short it, you owe that dividend. And that dividend will be paid monthly. So you're going to pay about 1% per month on that dividend. So if any of you are interested in closed-end funds, do your homework. They trade on the New York Stock Exchange themselves. They don't trade on the NASDAQ. They have NASDAQ symbols, but they trade on the New York Stock Exchange, and most of them are based around asset-based managers or around banks. Most closed-end funds are bank-issued or asset manager-issued. So be careful. They're not a layup. They pay great dividends. They're a nice diversification vehicle, but you got to know how to price them and not chase them at the wrong price. So that was me answering an email that came to me. And it's what I call the death to jargon, which is to demystify and clarify and break down some of these wonky, kind of like intimidating terms or products that people may not be aware of. In the meantime, I'm going to turn this over to Brandon Chapman. I have to get prepared for a Genesis COG, which comes in at 1 o'clock today. Make sure if you don't get the Zoom link that you reach out to us, and we'll make sure you get it because it begins today at 1 p.m. to 2:30 p.m. On that note, Brandon Chapman, how are you?
Good. How you doing?
Just, I'm having a real good day on the short side. Not the long side, but the short side. Shorts are really cooking, Brandon. I can't say we're at the top yet, but I feel like, now that my shorts are starting to really work, we're getting closer. When my shorts start to marinate, that's when I know like the top is actually approaching closer.
Yeah, we did an earnings trade in VFC yesterday. We closed out this morning for 100% gain in a day. So, but I'm trying to close out longs. Like I got a long USO, we're a long plug. It just gets right up to where I need it, right where my limit order is, and it just backs off it. We're just bumping up against it. We're going to talk about it, managed stuff ahead of the Fed today.
I hear you loud and clear. I don't know what the Fed's going to report personally. I won't trade ahead or around it, but I just feel like the Fed news today is just going to be on deaf ears. I don't think it's going to make the market sell off or to make the market rally. I think the market's going to do what it's going to do. I don't think the Fed has any impact because I don't think the Fed is going to cut rates the rest of the year. That's what I believe.
But that's going to have an impact, though. I mean, ultimately. So, I mean, what we're seeing right now is there's much more of a stagflationary posturing going on right now. We'll see how it goes. So, but if we don't cut, that's going to affect bonds. That's going to affect stocks. And that's what we're seeing in the option market today.
All right, we'll see about that. But I'm sitting on the sidelines watching, and I feel rather safe than sorry. See you later.
All right, have a good one.
All right.
All right, so let's kind of talk. We're gonna address today in Ghost Hour. So look, today's agenda. We're gonna look at the VFC earnings results.